Hello and welcome to another episode of Investing with IBD. It's Wednesday, December 20th, 2023, and we're coming into the end of the new year, or I guess the end of the year, coming into a new year, and it's time to check to make sure that your portfolio has the right vibe. So, are you flowing with the Fed or are you being left out to dry? And that's what we're going to be talking about today on the Investing with IBD podcast. Joining me, as always, is Arusha Paris from O'Neill Global Advisors. He's a portfolio manager over there. Any New Year's plans for yourself, Arusha?
No, not really. I guess we'll just be doing the podcast more.
Yeah,
That's
just the podcast,
yeah.
right? And of course, we're going to have Jim Ropel for that. But for this week, we've got Randy Watts. So it's another one of those cases where we've got O'Neill Global Advisors teaming up on the IBD podcast. Randy Watts, of course, is a senior portfolio manager. I had to add that just to make sure you understood that, Arusha.
Oh, I,
He's
I I
he's got the
understand the
senior.
roles around here.
Okay,
Randy
perfect,
is the
perfect.
man.
So, and of course, gosh, I've known Randy for a while back when we were in the building together and stuff. So it's great to have you on the show because we are in such a transition period with the Fed. So I'm excited to get your thoughts on this. We're going to do the education segment first this time around because that really sets the stage for the market and stocks. But glad to have you on the show, Randy.
Great to be here. Excited to talk to you. It's been a little while, though. I'm very lucky. I get to talk to Arusha daily. So
Well, lucky, unfortunate, tomato, tomato. So, but let's go ahead and start because certainly one of the things that's the most important news lately with the Fed is this kind of dovish pivot they did at their last meeting. And, what's your take on this?
well, a couple of things. Inflation has been slowing. It's come down a long way. The last PCE print was running about 3% year to year. So not quite at the Fed's 2% target, but definitely getting there. So we've made a
Hmm.
lot of progress on inflation. The market's been very anxious about this pivot, and it's actually forecasted it way before it actually occurred.
Yeah.
And if you go back a year ago, the market was actually looking for the Fed to be cutting rates this past fall. Now, the forecast on the new Fed dot plot is actually 3 rate cuts in 2024. So risk assets, particularly more speculative, levered assets, have really reacted very positively to this new information from roughly a week ago that the Fed thinks they're going to be cutting rates in the new year.
Hmm. And this is something that's kind of you mentioned this that the originally the market was kind of forecasting that rate cuts were going to happen at the end of this year, and that didn't happen. Then kept on getting pushed back, and it seemed like it. The Fed funds futures was getting tossed to and fro with every economic report, especially PCE reports, CPI reports when those would come out. Um, this time, did the market get it right a little bit? Did the Fed kind of, oh, you know what, we're going to come meet you where you're at, market, or what kind of happened there?
I think inflation has come down enough that the Fed feels that they're near the end of their tightening cycle. Now, that may be overly optimistic. We'll see. But one of the things that's really happened is the market is right now forecasting kind of a Goldilocks scenario for next year. Earnings for this year are supposed to be about 217. For next year, the street's using about 241. That's about 11% earnings growth. And it's forecasted for inflation to fall. The Fed thinks we're going to, on the current forecast, we're going to exit next year at about a 2.4% inflation rate, and we're going to get 3 rate cuts. So if you really think about it, right now, you're kind of getting everything you could want from an investment standpoint: earnings growth,
Hmm.
lower inflation, and an easier Fed.
Hmm.
So Randy, maybe for a lot of the listeners out there, maybe explain why the Goldilocks environment is significant, especially for growth stocks.
Well, so one thing that's very important, and I know we're going to talk about fighting the Fed in a minute, is that at the end of the day, stocks are financial assets, just like bonds. And the valuation you assign to them is based on 2 factors: the earnings stream a stock can generate and the alternative use of the money.
Hmm.
And the alternative use of the money for stocks, in the easiest, most simple sense, is bonds. And so as rates fall, the value of stocks increases. And at lower rates, you're willing historically to pay a higher price earnings multiple for a stock. So when the Fed starts to ease and rates start to fall, that usually means that the stock market is going to get a price earnings multiple expansion. And obviously, that's very good for stock returns.
Mm-hmm. Well, and now there's another aspect here too, because a lot of times the movement of the Fed is kind of based on projections of economic activity, or sometimes a slow, slow what's happening with economic productivity, especially in the case of inflation that's gotten up there as it did this time around. So I guess that's the other issue here. If they start cutting, does that mean that the projection of economic activity is, oh, things are going to be getting worse and we're trying to stave this off, and recession, there's all the talk about the hard landing versus the soft landing. So is rates coming down a good thing for the economy, or is it, hey, there's trouble and it needs help?
Okay, so there's 2 points there. The first point is normally rates coming down in a longer term picture is good for the economy. It stimulates business demand and capital spending, and it's very good for housing. And remember, housing is roughly, over 10% of the US economy. So in the big picture, rates falling is stimulative to the US economy. Now, if we talk about the way a rate cycle normally works, is that the economy is growing, it's growing too fast. The Fed raises rates to try to slow that growth down. Historically, they raise them too much. Then what happens is the economy starts to slow, oftentimes pretty rapidly, and then the Fed cuts rates. Normally, when the Fed is first cutting rates, that is actually a little bit of a negative, because as you mentioned a minute ago, oftentimes the reason they're cutting rates is because the economy is rolling over. So initially, historically, with regard to stock performance, when the Fed cuts, that's actually usually a short-term negative signal for stocks. However, if you go out a little ways, it's actually a positive signal. The Fed is always able to engineer the recovery of the economy by bringing rates down. And so when you're at the beginning of an easing cycle, there may be a little pain up front, but historically, that usually means good things for stocks farther out. I hope the way I said that was clear.
Yeah, and so maybe to illustrate it, we can bring up we had our colleague Kenley Scott. He diagrammed really over history a number of times when the rates were cut and what happened in the market, and so we probably can bring that up here in a second. And so yeah, Randy, you can take a look at this and maybe walk us through this. And so for those of you who are listening to the podcast, you can always go to investors.com/podcast and see some of these charts that we're pulling up. So Randy, so maybe walk us through this, and this is really starting with. Go ahead.
So on this chart, the gray line is the stock market, okay, and then the blue line is the Fed raising, and the pink line is them cutting. And you can see a lot of times when they first cut, the market goes down because the market's realized we're in an economic slowdown. Okay. But then over time, that actually the market bottoms out, and with lower rates, it starts to do much better. Now, one thing that's a little bit different this time around is this slowdown has been so anticipated. We've been talking about it now for a year and a half, that it's a little bit of a different scenario. And I'm not sure we're going to have the same effect with regards to stocks from the Fed lowering rates. The bond market has had a huge move. Bond yields peaked intraday on the 10-year on October 23rd at over 5%. We closed today on the 20th with rates on the 10-year under 4%. So bond yields at the 10-year time horizon have actually fallen over 20% in less than 2 months. So I actually think that's bullish for stocks. It's bullish for risk assets. And we've seen that. And that's what's really one of the big contributing factors that's led to this very strong end of the year rally.
And a lot of people have been, for a while now, talking about that inverted yield curve. The inverted yield curve that almost always has a recession coming behind it, and the inversion's a little bit less now with that 10-year coming down as much as it did, and some of the shorter term ones maybe coming on the way too, in anticipation of what the Fed is doing. But is that still something that you think is an indicator that's worth looking at, that inverted yield curve, and what that means for a potential recession?
I think it is an indicator that matters. It's got a pretty good track record of forecasting slowdowns. Normally, the way the curve resolves its inversion is the economy does slow down and then the short end of the curve collapses. So the way it normally uninverts is not with the long end going up, it's with the short end falling a lot.
Mm-hmm.
Okay? And especially at the beginning of these rate cutting cycles like we're looking at on the screen. Now, the inversion is about 50 bips, which is historically not a great level for stocks. But we're in a kind of an unusual time, and it's a very different cycle. And we'll see, we'll kind of see what happens. I think the most important economic metric to monitor is employment. And what we've really seen over the last year is that in America, if someone has a job, they're spending money. So the reason the economy has been able to hang in there is because, despite things like a slowdown in housing, et cetera, is because employment has remained so good. And this most recent couple of months, employment went up to 3.9, but last month it came down to 3.7. So unemployment is still very, very low. And if it remains low, it's likely that the economy is going to be okay. And I think this is what the market's counting on for hopefully a soft landing next year.
So maybe Randy, talk about, because it's been a really interesting year, obviously, for most of the year, the Mag 7 was dominating the environment. But with the Fed pivoting and getting more dovish, we started to see the Russell 2000 start to participate more. We started to see more participation and broadening of the rally. Maybe talk about kind of maybe that potential transition into more of a broad-based market.
The large cap tech stocks, the mega cap, the Magnificent Seven, are really essentially defensive stocks because they've got a very high likelihood of success. Their earning, their earning stream is pretty stable relative to small companies. Small companies have a couple of factors. First is their balance sheets are not as good as these huge mega cap tech stocks. As a result, when the Fed is raising rates, that puts pressure on the small cap stocks in terms of their ability to raise capital. When the Fed is lowering rates, it makes the capital environment easier. So that's very good for small cap. The other thing is that small cap stocks are much more levered to the US economy than the large cap. Large caps get a big percentage of their sales from overseas. Small caps in general are, are almost entirely domestic. And so they're very focused on the US economy. So now that people are starting to believe we could have a soft landing, that's actually very bullish for small cap stocks. Small stocks have lagged large cap stocks greatly over the last 2 years. And if you look at the market now, the S&P, the NASDAQ, and the Dow are either at new highs or flirting with new highs. Whereas the Russell is still more than 20% away from a new high. So if we have turned the corner on small cap stocks, there's still a long way to go in this cycle.
You kind of bring up some of the differences between these, multinational companies, especially the Magnificent Seven, and the smaller companies. Should we get a little bit of the discussion of the dollar in here? Because certainly, whenever you get a strong dollar, you start hearing the multinationals start talking about forex exchanges, and what that does to their earnings and revenues when they do those foreign currency exchanges. Is that something that's part of the equation here, or is that really kind of secondary? Because
it's part of the equation. Listen, the Fed is the bank to the world. essentially, right? It's the biggest, most important central bank. When the
Reserve
Fed begins,
currency and all.
when the Fed begins an easing cycle, it affects everyone globally. When the Fed is tightening, you should think about interest rates as a bribe to have someone hold your currency, okay? When the Fed is raising rates, the dollar is rising, as it has this last year. And that has a couple of effects. One, it normally puts a lot of pressure on emerging markets. And next, it hurts corporate earnings because there's a negative currency translation, especially for large caps, as they translate the profits overseas back home into dollars. When the Fed is easing, that's good for emerging markets. That usually lowers the dollar. And in fact, the dollar has come off of recent highs. It's trading about 101, 102 versus the basket right now. Earlier in the year, it was more like 104, 105. Okay. So we have seen the dollar give up some gains relative to foreign currencies. We've also seen, as the dollar comes down, that's stimulative for the emerging market indexes. So the dollar does matter. It matters more to large cap than small cap because, again, the small caps are not getting a huge percentage of their sales overseas in general. Obviously, there are some small cap companies that get a lot of their sales overseas, but in general, the Russell 2000 gets a smaller percentage of its sales overseas than the S&P 500. I think the S&P 500 gets something like more than 25% of their revenues, if I remember correctly. So the dollar translation effect has a much bigger impact on large cap. Now, as the dollar comes down, that's actually a positive to help earnings for 2024. So if you think we're going to have a weakening dollar next year, that actually should increase your confidence a little bit of the ability to hit the earnings targets for large cap.
So to kind of put a bow on this, since it is Christmas, what should investors really be thinking of? Again, it's the overall theme. Of course, this is said over and over: don't fight the Fed. We've really kind of had a very unusual time period because certainly with COVID and so much stimulative effects, not just from the Fed, but of course from legislation and the stimulus checks, everything that was happening on the stimulative side, and then supply chains getting disrupted, everything that kind of led to the inflation side. What can we kind of gain from this historically, since this is a little bit unprecedented? But what should people be looking at in terms of the correlations with past events that have happened with the Fed?
So a few things. One, interest rate movements, interest rate changes by the Fed are like potato chips. They rarely can have just one, whether it's a hike or a cut. Okay. Yeah. So if the Fed is entering a new cycle where they're going to start cutting rates, then that means there's probably going to be a few of them. That's the first thing. The second thing is, I feel, there's three things I want to say. The second thing is, I feel that we have likely seen the highs in bond yields for this cycle. I do think we are now in a permanent higher trading range of inflation and interest rates than we were over the last 10 years. Okay. So we're not going back to 75 basis points on the 10-year. Okay. The new range is higher. So maybe the new range is, I don't know what it is. Maybe the new range is 3 to 5 or 250 to 5 or something like that. So that means for fixed income investors and for individuals, this is probably a good time to extend duration in your fixed income portfolio. Now you've kind of missed the high, but if the Fed is going to be cutting next year, those rates are going to be coming down. So this might be a good time to take some of that money you have in money markets and extend it out, 2, 3, 5 years. So that's kind of the next point. And then the final point is, oftentimes in these cycles, the declines in inflation are not linear. So there's an awful lot of good news in the stock market. There's an awful lot of good news in the bond market. It would not be beyond the realm of possibility to get an inflation print in the first half of the year that goes the other way. Now, that doesn't mean a trend change, but it just means you're not going to be, every print doesn't have to be perfectly in line. And if that happens, that could really upset financial markets in the short term, given how much we've run. I mean, the market is very, I don't want to give a mixed message. The market is very overbought in the short term, both in fixed income and in stocks. Now, Do I think the fact the Fed is turning its cycle is bullish for financial assets? I do. Do I think next year can still be a positive year? I do. But we've had a huge move in a very short period of time, and it would not be unusual for us to give some of that back.
Well, we'll definitely get into some of those details in our next segment when we talk about the market. So stay tuned for that. We'll be right back after this short break.
MarketSmith will give you a huge edge in the stock market. Better stocks, bigger profits.
MarketSmith is the top research platform for IBD.
It's just the best tool for individual stock selection.
Everything within MarketSmith is designed to bring those best stocks to the surface.
It does a lot of the work for you of filtering down to the potential leaders.
It's when you take the training wheels off and you're ready to invest on a more professional level.
MarketSmith will help you take control of your investment life.
If you want to get serious about investing, start your membership today.
Welcome back to the Investing with IBD podcast. It's Justin Nielsen here, your host, along with Arusha Paris, who joins me every week. He's a portfolio manager over at O'Neill Global Advisors. And speaking of portfolio managers at O'Neill Global Advisors, we've also got the senior portfolio manager, Randy Watts, who's joining us today. He just talked to us a lot about the Fed and really kind of helped put down the, I guess, the environment that we're in. With the Fed kind of turning dovish and what that can mean for the stock market. But let's get a little bit more granular if we could, Randy, and take a look at the current market. You did mention in the last segment how we had such a strong November and we have gotten to overbought conditions. So while you might be bullish long term because of those Fed cuts coming, in the short term, what's the expectation here?
Well, I would say, let me say a couple things. First, my big prediction for next year, listen, I don't know if the market's going to be up or down next year, but I think it's going to be a very volatile year, very volatile. So I think people should kind of strap in for an up and down ride. Normally, the fourth year of the presidential cycle, the election year, is the second worst year of the cycle. And the first quarter is usually a flattish quarter, which is different than the first quarter cycles for the other years. So normally the first quarter of the election year isn't that great a quarter, and you get a lot of your gains in the election year after the election. Okay, and we've anticipated, as we talked about in the first segment, an awful lot of good news already at the end of the year. So I view the beginning of the year with a little bit of trepidation. The market is overbought, the bond market's overbought, and to show you the magnitude of the move, with regards to the Russell 2000, because we were talking about small stocks a minute ago, it's the fastest move ever from a 52-week low to a 52-week high for the Russell.
Wow.
Russell went up 20%, went about 23%. So that's a pretty fast move to do that in under 2 months. So normal market action would either be sideways or to pull back to digest some of these gains.
So Randy, to strap people in, like to try to reduce the volatility, just kind of the normal things, raise a little cash, try to get in lower beta stocks, those kind of things for investors.
I think you don't have to be in a rush to buy. I think the market's going to the market always gives you opportunities. So I don't think you have to be in a rush or panic to buy right now. And I think there's some stocks that are up so much, but the prudent thing is to take some money off the table. So, at work, we've been trimming some of our extended stocks because they're up so much. When you have a stock that's up 50% or something in 2 months, and a lot of these stocks are 10, 20% away from their 50-day moving averages, you've really got to be taking some profits off. That's the prudent thing to do.
Yeah.
I doubt it's going to be a straight, much like we talked about inflation bouncing around. I doubt the ride in stocks is just going to be the straight escalator up next year. I think there's a lot. Listen, we still have 2 wars. We haven't cut the rates yet, though the Fed has forecasted it. So we still have an inflation issue. We've got a very controversial is not the right word. I don't know what the right word is, but presidential election coming up. So there's an awful lot of stuff happening out there, and we've just had this massive move. So I don't think you need to be rushing into stocks here. And I would say it would be prudent to take some of the extended stocks down a little bit.
Yeah. And I think that's the big thing right now. It's kind of fight the FOMO. A lot of people, as you said, the Russell 2000 was just at 52-week lows. And now that it's at 52-week highs, people are like, wait, what just happened? And feeling like they missed a good portion of that, because if you were waiting for a pullback, yeah, that just didn't really happen in a big way. So yeah, I think a lot of people have this fear of missing out. It's come up so quick, so fast. They weren't as engaged or exposed, and yeah, there's a little bit of catch up, but you have to be very careful not to chase things. So it's finding that right balance. One of the things about, if we could kind of even get a little bit more granular, because today was a really interesting day in terms of the Russell 2000 just had gotten above 2000, and then today seemed like it was a nice follow up to that move that we had yesterday, where we kind of held above that 2000 well, but then big outside day today. A lot of stocks, what was it, around 11:30 Pacific time, the last hour of trading really kind of took it on the chin. Can you talk a little bit about what happens there? If we look at like the intraday chart, um, when you get a day like today where it just seems like relentless selling, um, what's going on there?
I think you're getting a little bit of a buyer's exhaustion, right? You've
Hmm.
had this huge move up. It's getting near the end of the year. A lot of people don't want to completely, redo their portfolios. People are starting to maybe take a little money off the table, and it's the holidays,
Hmm.
so people are starting to cut out for their end of year vacations, etc. So normally trading volume starts to dry up around now, and I would expect the next several days to be, Wall Street to be less fully staffed, and so I think that illiquidity can have an effect on it as well. But again, I think the primary thing is I think the market's a little bit exhausted from this dramatic move from October to today.
Hmm. Yeah. So yeah, let's again, we don't need to spend too much time on the granular, but uh, one other thing to just kind of talk about a little bit is, in addition to the Russell 2000, it does seem like the equal weighted ETFs. We've been talking a lot about like RSP, which is the equal weighted S&P 500. That was kind of suffering for a lot of the year. It looked a lot like the Russell 2000, in fact, but that seems to have gotten much stronger recently. Whereas before, we had a lot of strength in the Nasdaq Composite, the S&P 500. Is this telling you anything,
If
special?
if you get the Goldilocks scenario, which we talked about, which is lower inflation, lower rates, and good profit growth for the market, you're going to have a different set of leadership than you had last year. If you get that, if you really do get the soft landing and the Fed cutting rates and inflation coming lower, it's likely that cyclicals, value stocks, and small cap will lead.
Mm.
Okay. Now, normally when you enter a year, you don't get everything you think you're going to get. So, I'm extremely skeptical that you're going to have all three of those things play out. Okay, this Goldilocks soft landing. I would be great. I don't know what's going to happen, but I would be shocked if what we think I should come back on the show next year this day. I would be shocked if what happens is what everyone's predicting right now.
Hmm.
Right? We're going to get 3 cuts. We're going to exit the year at 2.4 inflation, and the S&P is going to print 241. I don't know which of those is wrong, but I guarantee one of them is.
Yeah, at least one, right?
At least one. At least
Mhm.
one.
Yeah. Now, so over the last couple of months, it's been a as we know, a pretty strong rally, and we've had a lot of stocks, junk off the bottom. A
Yeah.
really strong rally there.
Mhm.
Yeah. How many? Yeah, you've been doing this for a long time. How often does that type of rally happen that strong? And it's really like a lot of the lower quality stocks really starting to lead.
It happens rarely. It tends to happen when you're making a bottom economically and when you're making a bottom in credit contraction. M2 this last year was down for the first time since 1960. That's the a measure of money supply. That's very unusual. Okay. So it has been, for mid and small companies, a tough financing environment over the last year. and I'm sure you guys talk about this all the time. Arusha's an expert on IPOs. There were not a lot of IPOs this last year.
Right.
Okay. So financing got tough. You had a banking crisis. You had the Fed raising rates. You had an unfriendly equity window. So normally what happens when you get that kind of a move in these lower quality stocks is that you're turning the corner on the liquidity and financing cycle. So that the last time this really happened was really like the '09 period.
Okay, wow.
Remember in '09, we had a massive rally in low quality stocks.
Yeah.
Everybody thought everything was going out of business. It was the end of the banking sector, and then got stabilized and turned around, and the Fed and the government got easier, and stuff took off.
Mm-hmm.
Now, what's different this time around is that the economy never really had the same level of slowdown you had in the great financial crisis. So what's weird about it now is we're starting from a better place economically. Again, unemployment is 3.7%.
Mm-hmm.
That's a strong labor number.
Mm-hmm.
And so I think the question is, I mean, to be blunt, I kind of think it's going to be one of two things. Either the Fed is cutting rates, inflation is coming down, but the economy is not as strong as people thought it was going to be. Hence, you don't get $241 in earnings for the S&P. Or the economy is strong, profit growth is pretty good, inflation maybe doesn't come down as quick as people thought, and the Fed doesn't cut, or they don't cut 3 times.
Mm-hmm.
Now, I think a pretty bullish scenario for the market would be, it doesn't have to be one or the other. A pretty bullish scenario for the market would be, you don't do 241 in earnings, but maybe you do 230, right? 232 or something. That's still pretty good versus 217 for 2023. Maybe you don't get 3 cuts, maybe you get 1 or 2, but inflation comes down to 2.5, 2.6. That's actually a pretty good environment for stocks. I mean, you'd have profit growth again, and things are going the right way on rates and inflation. So I could see a pretty positive scenario occurring. I just don't think you're going to get, I'm sorry to be so repetitive, 241, 3 cuts, and 2.4% inflation. That to me seems overly optimistic.
Mm-hmm. And maybe you could, I know you kind of touched on this a little bit, but again, with the Magnificent Seven having gotten so much attention this year, really a lot of tech, computer software, enterprise seems like it really, there were definitely places to pick and choose.
Yes.
I mean, energy, not too long ago had its phenomenal bounce back. Are there any sectors that are kind of, to you, set up to take advantage of this change in environment? Whether it's the Fed, the earnings, the yields coming down, and any sectors that you think could particularly benefit? You mentioned value, some of the smaller caps, but any more specifics there?
So let me say a couple things here. First, while I talked about cyclical and value leadership, if we get a soft landing, I don't believe that's the long-term leadership of the market.
Mm-hmm.
So that's the first thing. Why don't I mention some themes, and then let me tell you some other things we like. In terms of themes that we're really focused on inside our group is still focused on AI.
Mm-hmm.
We're at the beginning of that. I think there's a possibility other companies that you don't think about for AI could get involved in it. I mean, no one's heard from Apple. I'm sure they're working on something. I'm sure they'll have their say at some point. We believe the weight loss drugs are a huge phenomena. We think we're if you use a 9-inning baseball game, you're in the 2nd inning of that.
Mm-hmm.
These could be the highest revenue drugs in the history of the planet.
Mm-hmm.
You could have millions and millions of people on these drugs. And right now, I think 2% of the population is on them. So, and something like, unfortunately, I think something like 30 or 40% of the US is technically obese. So that's a huge potential. Given the world we live in, unfortunately, cybersecurity, we still think is a massive theme. Coming out of COVID, we still think people are favoring experiences over items. So consumer companies that work with experiences is one. We think there's the potential for the housing cycle to turn around here. So that could be, very positive for a lot of stocks that have suffered this last year. So I think there are a lot of interesting places in the market you can go. Now, a couple of groups that have been beaten up over the last year, if we could pull up the charts, one is XLU.
Yeah.
That's utilities. If we can see it maybe better on the daily. If rates have really peaked and are coming down, that's bullish for utilities.
Mm-hmm.
And then another one is XLRE. If you have a soft landing, then real estate hopefully should do better. Real estate had a very bad year up until just recently. And Arusha, you can highlight the relative strength line on that chart. But this was one of the worst sectors in the market for most of the year. So those are both yield-driven groups that have suffered from the Fed tightening. If we're really going to turn the corner on rates, then, excuse me, if we're really going to turn the corner on rates, then that should be very good for these yield groups that have not had good years.
Mm-hmm. Well, I think this gives our folks a lot of things to think about. We really appreciate you coming on the show here, Randy, and sharing your thoughts on these broad sector themes as well as the broad economic impacts of the Fed. So we'll definitely maybe take you up on your offer and have you on next year to kind of do the year in review and see how things panned out. But we really appreciate you coming on.
Anytime, guys. Really appreciate it. Hope everyone has a great holiday.
Okay, you too. Okay, and when we come back, Arusha and I are going to take a look at some of the stocks that are potentially setting up, and we'll end that segment on that note right ahead of the holiday. So stay tuned. We'll be right back after this break.
MarketSmith will give you a huge edge in the stock market. Better stocks, bigger profits.
MarketSmith is the top research platform for IBD.
It's just the best tool for individual stock selection.
Everything within MarketSmith is designed to bring those best stocks to the surface.
It does a lot of the work for you of filtering down to the potential leaders.
It's when you take the training wheels off and you're ready to invest on a more professional level.
MarketSmith will help you take control of your investment life.
If you want to get serious about investing, start your membership today.
Welcome back to the Investing with IBD podcast. It's Justin Nielsen here, along with Arusha Piras from O'Neill Global Advisors. He's a portfolio manager over there. We just had a great conversation with Randy Watts. He had to go for this last segment, but I think Arusha and I can maybe muddle our way through, especially since we've got some guidance that we got from the first two segments. So yeah, let's talk about three stocks. And why don't we start, Arusha, with Alphabet? This is one that I guess, when we're talking about the Magnificent Seven, it seems like recently this one hasn't been participating as much. It's been kind of making this base while a lot of the other stocks have been moving so strongly in November. So, I mean, in a vacuum, I look at this base and I'm like, hey, this looks pretty good. But then I look at that relative strength and I get a little concerned. What's your take?
Yeah, I think that's the exact thing to keep in mind. It is actionable here. It is breaking out, but it seems like over the last 6 months or so, this has been the lagging stock of the Mag 7. So where you have like Meta moving into new highs, or of course Nvidia, but Apple's been doing pretty well, and a number of those other stocks. Here's Google finally breaking out today. It was struggling. I mean, remember on the earnings report, it gapped down
Mhm.
and then built some kind of V-shaped cup, came back in, started to settle down again, started getting a little bit more constructive here. Finally broke out, but now it's breaking out. All these other stocks have been moving for a little while, and as we were talking with Randy, it's been a pretty strong last couple of months here. And what has Google been doing, right? And you can see that with the relative strength line. It's been in a downtrend for during this whole time, and so yeah, it is actionable here, but you very well could be getting into laggard. So you just want to keep that in mind.
hmm And I guess this is a good time to kind of talk about the difference between a stock that's maybe a laggard and again a lot of the stocks are extended right now. So the ones that are actionable, you're almost like, well, where have you been? Why haven't you participated? But then on the other side, you could say, well, if there's sector rotation, wouldn't it be those stocks that haven't participated that would see the rotation? So how do you know whether it's sector rotation potential and this is where the money's going to now, or it's a laggard stock and you want to stay away?
Yeah, I mean, sector rotation, we've seen that pretty consistently over the last year or so. The problem is that this sector's already been doing well. It's been
Right.
rotated into plenty of
Yeah.
times, right? So I would still lean more. This is not necessarily sector rotation. It's more kind of the market going, okay, all these other stocks are extended. And yeah, I'm just looking even on the left hand side of the weekly chart here. I mean, you can even talk about like Snap, right? Now Snap kind of will fall in the category of lesser quality right now, right? This is probably more in the category of the junk off the bottom. I mean,
Yeah.
look at the move that this has had over the last couple of months right here. It's just been a rocket ship. Meanwhile, Google's been basing out. Now, yes, Google's much closer to all-time highs versus a Snap, but this is the type of rally that Google's missed out on, and all of a sudden now's the time that it's breaking out. And uh, when the market finally starts getting to some of the other stocks that haven't participated, sometimes that's when the market needs to take a break, right? The market's now saying, okay, we pushed up some of the better quality stocks, and some of the stocks have been beaten down so much. We run those. What else can we push up? And finally, oh, let's get back to Google. And
Yeah.
so a lot of times at that point, it's like, and we saw with the reversal today, it's like, okay, maybe now the market might need to take a little bit of breath. But that being said, it is only 1% below the pivot. On a price level, it is still right around that actionable point. But ideally, you want to see that relative strength line start to improve to get more excited about a Google.
Yeah, absolutely. And one of the ways that relative strength lines can improve, it's not just from the stock going up. If we do have a little bit of a pullback in the market here and your stock holds up better, that's another way for relative strength to improve and can often tell you, hey, there's something special going on if it's just not coming down as much. So that's definitely something to keep an eye on. Randy also mentioned how cyclicals may be a place to be looking for in the future. And I noticed, a nice move in copper recently. Some of the materials, if you looked at like XLB, for instance, that's the Material Select Spider ETF. And this recently kind of came out of a base, it looks like. And, again, the relative strength isn't as great on this one, but you could make the argument, hey, this could be more of that sector rotation happening into an area that wasn't as favored. So, getting back to copper, Southern Copper SCCO. This is one that looks like it's had a decent move here recently, coming up to the former highs at 87.59. A little bit of a down day today, but some really strong volume, in the last week as this was climbing up on the right side of this cup.
Yeah, well, a lot of times, one of those kind of market truisms is that when copper starts to run, the market's getting better. You could be getting back into a more of a bullish type of market. And so it is a positive to see a Southern Copper work on the right hand side of the base. And I totally agree with you. I mean, one of the things here over the last few weeks is that volume. So you're starting to see, and really probably even longer than that, you're starting to see a character change within the volume, and you're starting to see some nice spikes there happening. And then if I go over the weekly chart, but wanted to check the up down volume ratios of 1.3. So over the last 50 days, you are getting more up volume versus down volume. So there is some more power coming into it, 30% more up volume versus down volume. And then you have a B plus accumulation distribution rating on the stock too. And in this case, the relative strength line is starting to tick up also, right? So versus the Google, where the relative strength line was still in a downtrend, wasn't really doing a nice sharp move up. You're starting to see improvement in Southern Copper as it's building the right hand side. You're starting to see that relative strength line also starting to tick up.
hmm and we often talk about how cyclical stocks have to be treated a little bit differently. I mean, look, the EPS rating on this isn't bad. I mean, 95. That's nothing to sneeze at. But it certainly doesn't have, uh, the consistent growth. You do have some negative quarters, but it seems like a lot of things have some red quarters here lately. But a lot of times the cyclicals, you almost have to kind of get into them and put them on your radar when they might be negative and the projections forward are a little bit better. So it looks like the projections are for a decent 5% next year, but certainly you see some nice double-digit growth in the last couple quarters of earnings, and you know sales double digit this last quarter, but it wasn't really there before. So again, just something that you have to realize. You have to kind of treat these a little bit differently sometimes in terms of that those earnings numbers and revenue numbers.
Yeah, and I just switched over to the monthly chart too, Justin, where it is really close to getting into all-time highs here, and in many ways, this is it's kind of a little bit of an inverse head and shoulders there, and 80s really that key resistance, and it's starting to emerge out of that. So I think from a longer term perspective, this could be a positive too if it can get into all-time highs. Maybe it can start to trend a little bit better here. It's had some moments and some years where it's been able to do really well.
hmm And let's go ahead and wrap this up. While we're talking about kind of other areas that might be getting a little bit more love, Caterpillar. In the industrial area, this is one of the big industrials, of course, and this has had a nice move off of its bottom. So it's kind of all the focus has been on the tech, but there are these other areas that are really worth watching. And you know, I mean, this is kind of a very, very sharp move off the bottom. So I do think it would be very normal and constructive for it to take a pause here as it gets up to that 293.88 level that it hit back in July, August. What's your take on this one? Is there anything that you would look at in terms of Caterpillar, in terms of how to treat this a little bit differently, um, or anything like that?
No, I mean, I think you definitely want to take note of the move. It's been a strong move right up into new highs here, but you don't want to rush it, right? You talked about FOMO earlier in the episode. Be disciplined, let the stock settle down again, and then maybe consider it. But for the most part, it looks like it has its metrics are all pretty good here. And if you take a look like at the XLI is also right near all-time highs here too. So the whole industrial area is starting to act better. I mean, it is a little surprising that Caterpillar is doing pretty well with China slowing
hmm
down, right? And the FXI has been struggling, and a lot of Chinese stocks have been struggling. And so Caterpillar gets a big part of their revenue from China.
hmm
And so when Caterpillar was selling off, I was like, that makes complete sense because a lot of other Chinese stocks are selling off, and obviously Caterpillar's going to get hit. But here comes Caterpillar running right up. Maybe it's kind of benefiting from this really strong rally here, and so now I think we have to really see, okay, how does it pull back? Is it really going to continue to act constructively and maybe even set up something more constructive than this consolidation that it's done right now, and or is it just going to just kind of get fall back into this trading range and just go sideways for a while? So I think it's a little too early for this, but this is a time where you definitely want to do a little bit more research and say and try to figure out, why is Caterpillar doing so well, but a deer is still struggling,
hmm
right? And just try to figure that out. But the bottom line is that there are a lot of industrials doing well.
Yeah.
The infrastructure bill, a lot of that money hasn't been spent yet. And of course, Randy mentioned housing's doing well, and a lot of all the related industry groups towards housing have been doing really well too. So there are a lot of other areas besides tech and AI related stocks that have been participating over the last 6 weeks or so. And I think because of that more broader participation, that's a reason for optimism here in just kind of the market. And that I kind of try to tell myself, that there are a lot of stocks out there that are breaking out and giving you opportunities to get exposure to the market.
Yeah. And, just to your point earlier about SCCO, you look at the up down volume ratio on this one, it's 1.4. That's pretty good. You look at the earnings, again, it's EPS rating of 93, a little bit more blue on this one, a little bit better in terms of the double digits being a little bit more consistent there. And then if you look at the daily, it's hard not to notice that big volume that we have again on the right hand side here. So I think with a lot of stocks right now, what I'm looking for is a lot of them have come up to these previous highs, or they've been running for a while. You could imagine them pulling back here, and I mean, during the holidays, a lot of times you get lower volume. I mean, we really did. If you go back to the market, we really have had some pretty strong volume lately.
Hmm.
A lot of big volume days in the market, and you could really see that tapering off potentially over the next couple weeks as we go into the holidays. Which, if stocks pull back and the volume starts trickling off, I know it's because of the holidays, but still, that's kind of the look that we want to see. So I could really see some setups coming out of that. And I guess part of it is just having that patience, making sure you're not taking too much of a clip. If there is a pullback to where you've gotten so overextended and ahead of your skis, chasing stocks that you get shaken out of stuff and miss the potential turn if it happens. I think this is definitely a time to be ready for the next push. If there is a pullback here, I think that's an ideal situation.
Yeah, how it pulls back is going to tell us a lot. I think now what we're up to maybe 3 distribution days on the Nasdaq. Is it was today the third distribution day
Yeah,
on the Nasdaq?
we did have up to three, but then one dropped off because we were
Hmm.
making so much progress. So my guess is that I'm guessing volume was heavier today. So yes, today would be the third distribution day on the Nasdaq. And I mean, look, this was not a great look. You just got to 15,000 and turn tail, big outside day. Uh, you're going to expect some weakness to follow, but that doesn't mean that we're not just going to be setting up for our next big push.
Yeah.
Yep. So that's going to wrap it up for this week, and certainly next week. Well, first of all, I want to make sure that everyone has a just happy holiday. We really appreciate the support and you sticking around with us while we talk about stocks and sometimes other things when we get distracted. But it's always a pleasure interacting with our subscribers and listeners. So we really appreciate you guys listening. Hope you all have a happy holidays. And as a kind of a nice way to ring in the new year, we're going to have Jim Ropel on next week. And, there's no better person to kind of finish the year off than with Jim Ropel. He, of course, is going to talk a little bit about what he sees for this year that we've had and why he's bullish coming up. So it'll be great to talk to him, get his take on. I mean, he's really super bullish. So it's a great to talk to him. You get a super optimistic sense of what's possible. And I can't think of any better way to end this year with and ring in the new year than with Jim Ropel. So we hope you join us for that. Thanks a lot for watching this week. We'll see you next time.